Let's see how the government safety net operated during the financial crisis of 2007 to 2009. This is a very important case study. What happened before 2007? The short version is that house prices peaked across the US in the summer of 2006. Then they fell rapidly. As they began to crash, fault lines in the financial system began to emerge. This chart shows a common measure of financial sector stress called the TED spread. This is the difference between the interbank rate, that's the required rate of return from lending to a bank, and the Treasury bill rate, which is the rate of return from lending to the US government. In normal times, there's very little difference. And then in bad times, a wider spread emerges. During these bad times, investors view the financial system as a riskier investment. The first major event of the financial crisis happened in August 2007. A large French bank called BNP Paribas halted withdrawals from 3 of its investment fund subsidiaries. These investment funds were heavily invested in US mortgages. After BNP, investors began to worry about which financial institutions were exposed to US mortgages. This was a period of increasing stress. Fast forward several months to March 2008. Bear Stearns, a large and famous US investment bank, experienced a run on its wholesale funding. The Fed had to arrange an emergency rescue by JP Morgan Chase. The stress was escalating. The collapse of Lehman Brothers in September 2008 sparked a broader panic. Measures of financial stress spiked up to levels never seen before. Credit markets froze, the stock market plummeted, and the spread to the broader economy was becoming evident. The government intervened to stop the financial panic and limit the economic fallout. I am going to highlight 2 aspects of the intervention. The US policy response was much broader, but I am just going to focus on the safety net for the financial system. First, we had the expansion of deposit insurance. On October 8th, 2008, less than 1 month after Lehman collapsed, the deposit insurance limit was increased from $100,000 to $250,000. The goal of this intervention was to prevent future runs. Second, the lender of last resort provided temporary cash loans. The Federal Reserve calls them liquidity facilities. There were several facilities opened up to cater to different borrower types. They were up and running in early 2008, but they greatly expanded during the panic. They all served the same purpose, to stop runs that were in progress. Later on, once things have calmed down, the Fed gets paid back. Let's wrap up. Banks are prone to large cash shortfalls. This is why they are fragile. Banking panics are bad news. An initial shock to one bank can spread by contagion to many others. Even healthy banks can be brought down during a panic. This creates a role for government intervention. We saw how deposit insurance and the lender of last resort deal with bank runs. What's the catch? Well, having a robust government safety net cushions bank managers against failure. This can create moral hazard. The same way that an insured car driver might worry a little less about a small crash, bank managers may be willing to accept greater risks. Going forward, we will see how bank regulation and supervision is designed to tackle this problem.